How long until China becomes the largest economy in the world? There was always a degree of inevitability about China overtaking the United States for the economic top spot, but China's response to the COVID-19 pandemic appears to have accelerated its progress. According to the UK-based think tank, the Centre for Economics and Business Research, China could overtake the US in 2028. That is 5 years earlier than the expectation from only a year ago. And it's because China is weathering the pandemic better than Western countries. But what does this change around in the world economic order mean for your investment portfolio? In this video, I'm taking a look at the findings of the CEBR World Economic League Table and explaining what all of this means for how we invest our money. Hi everyone, I'm Martin Bamford, a chartered financial planner at Informed Choice. On this channel, I talk about personal finance, investing, and happiness. I make these videos to help you become wealthier and happier. If that sounds like a great result, click on that little red subscribe button to become part of our subscriber community. It's completely free and you'll never miss an episode. The latest World Economic League Table from the CEBR shows that the US and China will trade places in dollar terms by the end of this decade. It also shows that China is on course to become a high-income economy by 2023. That means it's on track to pass the per capita threshold of $12,536. Despite strong economic growth, the average person in China will still be poorer in financial terms than the average person in the United States. That's because China has a population 4 times larger than the US. Also performing well in economic terms in the East, India looks set to move into 3rd place in the Global Economic League Table by the end of this decade. That's an eye-opener because the size of India's economy currently sits in 6th place in the world, 1 spot behind the UK. What is driving such strong economic growth in China and in Asia? Only last month, Chinese President Xi Jinping said it was entirely possible for the Chinese economy to double in size by 2035. This forms part of his government's new 5-year plan, aiming to achieve modern socialism within 15 years. In terms of the pandemic, China took the economic hit first. It took it early, but it has recovered quickly from COVID, at least according to its official government data. The CEBR says that Western governments should pay more attention to COVID recovery in Asia. The report says typically we compare ourselves with other Western economies and miss out on what is often best practice, especially in the rapidly growing economies in Asia. In fact, CEBR referred to China's management of COVID-19 as skillful and attributed its pandemic response to a boost in relative growth compared to the US and Europe over the coming years. When we look at how China handled the pandemic, it went in hard in the early days, but avoided the subsequent and very disruptive lockdowns experienced in the West this year. As a result, it A, avoided economic recession this year, and B, is on track to grow by 2%. Compare and contrast that with the US, currently the largest economy in the world, and home, sadly, to the worst death rate from the COVID pandemic, at more than 330,000 dead and counting. In the US, there has been huge economic damage, softened to some extent by the significant monetary and fiscal stimulus put in place. Despite government and Federal Reserve intervention, though, the US economy is expected to shrink in size by 5% this year. The CEBR says in its report, for some time, the overarching theme of global economics has been the economic and soft power struggle between the United States and China. The COVID-19 pandemic and corresponding economic fallout have certainly tipped this rivalry in China's favour. Another factor accelerating growth in China is its aggressive policy making, targeting industries like advanced manufacturing. CEBR Deputy Chairman Douglas McWilliams, speaking to the BBC, said they seem to be trying to have centralised control at one level, but quite a free market economy in other areas. And it's the free market bit that's helping them move forward, particularly in areas like tech. In terms of forecasts, the CEBR is expecting to see a strong post-pandemic rebound in 2021 in the US, followed by annual growth of 1.9% between 2022 and 2024, and then slowing to 1.6% a year afterwards. The Chinese economy is forecast to grow by 5.7% a year until 2025, and then 4.5% a year between 2026 and 2030. Between the year 2000 and now, China's share of the global economy has risen from 3.6% to 17.8%. Turning our attention to the UK, the CEBR thinks that the UK economy will grow by 4% a year between 2021 and 2025, and then growth will slow to 1.8% a year from 2026 to 2030. The UK is currently the 5th largest economy in the world. It was pushed down into 6th place by India, but the impact of the pandemic means that India is one place behind the UK again, and it's not forecast to overtake us now until 2024. After that, India is on course to overtake the size of the German economy in 2027. Germany is currently in 4th place, and then Japan currently in 3rd place in 2030. The size of the UK economy, measured in US dollars, is on track to be 40% larger than that of France by 2035. On a global basis, environmental factors could start to have a serious impact on the shape of the world economy during the next 15 years, according to the CEBR. They said sea levels are expected to have risen by 45 centimetres from the 2000 base by 2035. This compares with the smaller 20 centimetre rise by 2030, predicted 2 years ago. One consequence of transition to a net carbon zero economy in the coming years is weaker demand for fossil fuels and therefore lower oil prices. The CEBR forecast the price of benchmark Brent crude to fall below $30 a barrel by 2035. There is a lot to digest in these forecasts as we think about what they might mean for investment strategies in the years to come. I think it's important to keep in mind that the relative size of different economies is always shifting. This shifting order is one reason why investors need to take care not to invest blindly. For example, take a closer look at Japan. Once the 2nd largest economy in the world, Japanese equities previously formed a significant part of global equity allocations. In the late 1980s, Japan dominated the MSCI World Index, a popular investment index forming the basis of global equity index tracker funds. At its peak, the Japanese market was 44% of the MSCI World Index. That was more than double Japan's share of the global economy at the time, but reflective of the market capitalization of its equity market. Roll forward to today, and Japan is now 7.87% of the MSCI World Index, with the US at 66.1% weighting. Again, that's around double its share of the global economy. Right now, the United States dominates global investment markets. When Tesla entered the S&P 500 index last week, I joked on Twitter that it turned the index from the S&P 5 into the S&P 6 by virtue of the massive market cap of Tesla, plus Facebook, Apple, Amazon, Netflix, and Alphabet or Google. There's another critical issue at stake when we think about China's role in global equity allocations, and that's because China gets a tiny weighting to the MSCI World Index because its A shares are mostly owned by domestic investors and they're therefore excluded from MSCI. There's a disconnect between the size of a country's economy and the size of its stock market capitalization. That's because profits are often earned overseas. For example, the FTSE 100 index of leading UK company shares earn around 70% of revenues from overseas. That's why the FTSE typically does very well when pound sterling falls in value, because those revenues from overseas suddenly become more profitable. As the world economic order continues to shift, be prepared as an investor to demonstrate some flexibility. Take care not to get stuck in outdated beliefs about the US and Japan dominating, or indeed about oil stocks being one of the most valuable parts of your portfolio. As always, when it comes to investing, diversification, spreading your risks, is a key to success. UK resident investors have a habit of weighting their portfolios to UK stocks. This home bias is common for investors around the world. We tend to stick with more familiar holdings, as well as finding it easier to trade in local companies. But we can reduce risk as investors by investing in overseas companies too, as any changes to domestic markets, for example Brexit, are less likely to be felt in every country across the globe. Now, I'm not encouraging you to start buying up Chinese and Indian stocks or even overweighting these countries in your equity portfolio. Even if you wanted to, it's not that easy to do as a UK-based investor, to invest and to buy the same Chinese stocks that Chinese investors are buying right now. But please do recognise that things change over time. The next decade or two is looking increasingly likely to favour Asia, also to see the dominance of the US economy shrink slightly on the global stage, and to see the European Union's share of the world economy shrink too. What worked worked in the past won't necessarily work in the same way in the future. If 2020 has taught us anything, it's the need to challenge our preconceptions when it comes to the path of economic growth, investment markets, even government policy. Tell me then, what changes, if any, will you make to your investment portfolio to get it ready for the next 10 years? Let me know in the comments. Thank you for watching this video. Are you already part of our subscriber community here on YouTube? If you are, thank you very much for supporting these videos. If not, click on that little red subscribe button now to join our subscriber community. It's completely free and you'll never miss an episode. Until next time, I'm Martin Bamford, and remember, when it comes to your money, the more you know, the faster it can grow.